this video, we will be looking at a common pricing strategy being used in businesses today, cost plus pricing. We will look at what it is, how it can be calculated, and analyse both the advantages and disadvantages of using it. But before we look in detail at this specific pricing strategy, let's make sure we can define the terms used. The total amount spent on making the product is the cost of the product. This would also include the overhead expenses such as employee wages, utility bills, and any other expenses related to making or manufacturing the product. We will discuss costs in more detail later in this video. The amount the customer or the buyer pays for the product or service is its price. The price should, of course, be greater than the total cost of the product in order to make a profit. The difference between the price the customer is charged and the cost of creating the product determines the amount of profit that is made. Now that we understand these definitions, and by simply looking at the name of the strategy, cost plus pricing, it makes sense that the pricing strategy is used to determine a product's price by adding on an additional amount to the cost of making it. The additional amount added represents the profit you want to get for each product. This additional amount of profit is usually a specific percentage of the total cost, like adding on 50%. This is known as the markup. Before we take a closer look, let's introduce this video's main example, and take a look at whether cost plus pricing is the correct strategy for him. This is Paddy O'Connor, and he has decided to spend the weekend creating and selling fresh lemonade from a small stand at a local arts festival. The event is taking place in his village and is expected to have over 2,000 visitors throughout the day. Paddy is hoping to make at least 50% profit for all of his efforts by the end of the weekend. Using cost plus pricing will mean that it should be easy for Paddy to price his lemonade so that if every glass is sold, he will have made his target of 50% profit. To all the teachers out there, show all of these videos without any ads and gain access to our growing library of over 500 teaching worksheets. Why not visit BizzWizard.co.uk to find out more? Okay, so for Paddy to use cost plus pricing, he first needs to work out his total costs. This is often seen as just TC. This is the sum of his fixed costs, also known as FC, and his variable costs, also known as VC. So, you may be thinking, well, what are fixed costs and what are variable costs? A fixed cost is a cost that does not change regardless of the number of goods or services produced or sold. Fixed costs are expenses that have to be paid by a business, regardless of whether they have any sales. Fixed costs can be things like rent, insurance, and broadband, and many other things that are a set fee. A variable cost, however, is a business expense that changes in proportion to the amount produced. Variable costs increase or decrease depending on a business's production volume. They rise as production increases, and they fall as production decreases. Examples of variable costs include the costs of raw materials and the costs of packaging. So let's have a think about the fixed costs and variable costs for Paddy and his lemonade stand. As Paddy is running a small business, he has limited costs. His fixed cost is the price he must pay to rent the stall he will be selling from. This rental fee also includes the necessary insurance he needs to sell to the public. He also has decided to make a professionally printed banner made for his stall, which has cost him an additional £50, and this will not change regardless of whether he sells any lemonade or not. So Paddy's rent is £450. His sign is £50. So his total fixed costs is £450 plus £50, which makes £500. Now, what about his variable costs? Well, these costs depend on how many glasses of lemonade he sells. He has calculated that the ingredients for each glass will cost 40p, and that each cup will cost 10p. These are his variable costs, and they change depending upon how many glasses Paddy needs to make. So, now we need to calculate the variable cost per unit. This is the total of all variable costs for each glass. In Paddy's case, 40 pence of ingredients and 10 pence per cup, which gives a variable price per unit of 50 pence. This is sometimes known as the VCPU. Finally, Paddy needs to calculate his total costs. Well, this is the sum of the total fixed costs and the total variable costs. Here, Paddy needs to choose a number of units, glasses of lemonade, he will be producing in order to calculate his total variable costs. Paddy has decided to make 1,000 glasses of lemonade for the art festival, so the total variable costs are his variable cost per unit, in this case 50 pence, multiplied by the total number of units, in this case 1,000, giving Paddy a total variable cost of £500. He is now able to calculate his total costs by adding his total fixed costs to his total variable costs. For Paddy, this is £500 of fixed costs and also £500 of variable costs, which give him a total cost of £1,000. Bring this video and over 100 more to life with fun, interactive games, quizzes and case studies. Why not try the first 25 completely free by visiting BizzWizard.co.uk. So now that Paddy has his total costs, he can calculate the price he will charge customers by adding his markup to the total costs. If we remember earlier in this video, Paddy wants to apply a 50% markup. Now he knows his total costs, he simply needs to multiply this by 1.5, which is the same as adding 50%. You can think of 1.5 as also being 1.50. The 1 is the total cost, and the 0.50 is the 50% that Paddy wants to add on top. So let's do this calculation. 1,000 times by 1.5 equals £1,500. So this means if Paddy hopes to make his markup of 50%, he will need to achieve a sales revenue, the total money taken, of £1,500. So how much does Paddy need to charge for each unit, or in his case, glass of lemonade? This can be calculated by dividing the sales revenue he needs to achieve of £1,500 by the total units, in this case 1,000. 1,500 divided by 1,000 equals £1.50. This means that to achieve his markup of 50%, Paddy needs to charge £1.50 per glass. If Paddy decided he wanted to increase his markup, he could do so easily by changing his multiplier. He has been using a multiplier of 1.5 for 50%, but let's say he had a change of heart and decided he wanted to make 75% profit. He could then use a multiplier of 1.75. So, 1,000 times 1.75 equals £1,750. In order to calculate the new selling price, Paddy would need to divide £1,750 by 1,000, the number of glasses he intends to make. So £1,750 divided by 1,000 equals £1.75 per cup. So now that we have a strong understanding of how to calculate cost plus pricing, let's analyse both the advantages and the disadvantages of this form of pricing strategy. The first and possibly most advantageous is that cost plus pricing is very easy to calculate. It can be quickly worked out and avoids trickier calculations for each product sold. Take as an example a restaurant. They may serve nearly 100 dishes. Setting individual prices for each dish based on its popularity can be time consuming, whereas adding on 50% to the total cost of each dish is much more straightforward. The time saved here by the restaurant owner could be used to focus on other aspects of their business, for example, improving customer awareness. In Paddy's case, with just the one product and a small window to sell to his customers, using this pricing strategy has made it easy for him to calculate his sale price by simply adding on a markup, as we have seen. Cost plus pricing will also ensure that all costs are covered and should lead to a profit being made. By pricing in this way, Paddy can ensure if he sells all of his lemonade by the end of the festival, he will have made a profit. It is, of course, important to remember here that Paddy would need to sell all of his glasses to hit his target of 50% profit. Finally, Cost plus pricing can be very useful when there are certain unknowns for the entrepreneur. For example, if you are launching a product that has not existed before, it will be very difficult to forecast the demand for this product, and cost plus pricing will improve the chances of the business making a profit. The same is true if you are entering a new market, for example beginning to sell in another country. Here, cost plus pricing could be a good option. Each of the video courses over at BizzWizard.co.uk also includes an interactive business case study that applies the knowledge learned to a real-world scenario. There are over 1,000 multiple-choice questions, each with detailed feedback, which tests students' understanding of the content. Why not visit BizzWizard.co.uk to find out more? However, as with all of the different pricing strategies that we will explore, there are a number of important disadvantages to consider. The first big problem with cost plus pricing is that it does not take into account the demand for a product. Paddy is making presumptions here that 1,000 guests to the festival will all want his lemonade. But what if they don't? What if people want milkshakes or a refreshing Coke? Paddy is not taking this into account. This could be a big error for Paddy and impact his chances of success. This could lead to considerably fewer sales than he is expecting, which may impact his ability to pay for his costs. The next disadvantage we will consider is that it can sometimes be difficult to account for all costs. For Paddy and his small lemonade operation, this has not been too difficult, but for larger businesses with a more complex operation, there can be many costs that do not get considered when using cost plus pricing. Another problem with this strategy is it does not account for competitors and the price that they are charging. Let's say Paddy shows up on the day and there is a rival lemonade seller just opposite him. This is going to be a problem. But what if they are also selling their lemonade for half the price that Paddy intends to? Now cost plus pricing really isn't going to work, and Paddy is going to have a rethink. The final disadvantage that we will consider is that cost plus pricing doesn't really encourage a business to improve and become more efficient. We have discussed in other videos that a business should be trying to reduce their costs, especially as they grow. But if they are just going to add a markup on top, they won't necessarily be focusing on reducing these costs. Only time will tell if Paddy chose the correct pricing strategy, and it is likely that some of the disadvantages that we have discussed may significantly impact his success. Remember, if you are being asked in an exam question to evaluate the effectiveness of this form of pricing, it will always depend on the particular business in the given case study. For example, this strategy would be unlikely to succeed in a very competitive market, with many rivals selling similar products, and you will need to analyse all of the advantages and the disadvantages discussed in this video before making a final judgment when constructing your answer. This has been the BizzWizard. See you in the next video.